Another thing that will cause movements in the exchange rate is the rate of return. So one thing that will move exchange rate is when we get different rates of return across countries. So what are we talking about? So we're talking about rates of returns on like things like bonds, stocks, other kinds of assets, right? So when a country has relatively high rates of return, so if you have relatively high rates of returns, then that attracts people in. So rate of return will attract funds. So people see, oh wow, the interest rate in such an everything else equal, they see interest rate in such and such country is 6%, and in your own country it's only 2%. So if everything else was equal between these two countries, well, you can kind of guess what people are going to do. They're going to want to move their money from the country with 2% interest rate to the country with 6% interest rate, right? And the opposite is also true. Then relatively low rates of return cause funds to leave. So there's all these international financial investors that move their money around based on where they can get the best return, and these can be anywhere from wealthy people with a lot of savings to large companies to pension plans like your local government pension plan, and depending on the rules that they have, they may be moving money from different countries to get the high rates of return. So this is going to mean when you have high rates of return, when your rates of return rise compared to other countries, you're going to get a lot of money coming in. And a lot of money coming in is going to be meaning a lot of people exchanging from their currency into your currency. Okay, and then when your returns are relatively low compared to other places, you're going to get a lot of funds leaving your country. So there's going to be a lot of people exchanging the money from your currency to the currency where they're headed. So this gives us the idea. Okay, so we're going to look at an example of the UK. Okay, so let's look at the UK. So this is going to be the British pound. Okay, so and over here we're going to, in terms of dollars, so this is the dollar per pound, and then this is the quantity of pounds traded for US dollars. Okay, so get the idea. So let's just start someplace. I'm not really concerned about what writing the exact numbers on here. So again, the demand is people who want to buy pounds. The supply is people who want to sell the pounds that they have in order to get dollars. So now what happens is we get, okay, the UK raises interest rates compared to the US. Okay, so compared to the US, they raise their interest rate. Their interest rates are higher. Their bonds rates go higher. Well, so what's going to happen? Well, the first thing is you're going to have an increase in demand for pounds, right? Because they want to, from people moving. Okay, this is on bonds, let's say. Okay, so yeah, up in demand for people moving money into the UK. Oops, to buy bonds. Okay, so this is going to cause an increase in demand, and at the same time, we'll also probably see some decrease in supply. They don't want to leave. Like we got less people want to leave the pound because now it gets higher rates of return. You might as well keep it in the pound. So we're going to less people want to leave the pound. So I get this thing going on, a little bit of decrease in supply. We don't know how big these things are exactly. And so we go from this original equilibrium at A to a new equilibrium at B, right? And at B, we're getting more dollars. So here, maybe this was, just to make up some numbers, maybe this one, they were getting $1 at 1.2, and now they're getting like $1.4 per pound, right? So we can see here the pound has strengthened against the dollar, and we can see that because we get more dollars and before we were getting $1.2 and now we're getting now they're getting $1.4, right? So the pound has gotten stronger. We could also, of course, say that the dollar has weakened against the pound. It's always an inverse relationship. So okay, so that's what happens when you have different rates of return across countries. In the last video, then I'll come back and talk about prices.